What is going on, investors? Hopefully guys are doing well out there. That is right. It is Friday. The weekend is here, but more importantly than all that, it's time for the FAANG Stock Recap Show here on the Investor Channel, where every Friday we recap all the major news and the technical chart patterns of the week from all the major FAANG stocks. And you'd think on the eve of earnings, we've got Netflix reporting next week. We've got Tesla reporting their earnings next week as well. You'd think it'd be a little bit of a slow news week, but in fact, not. It's a big news week. We got a lot of items to cover. Kick things off like we always do with Meta Platforms. Started the week closer to $163 per share. End of the week closer to $164 per share. This is after we've got an antitrust bill floating around the Senate floor. It's believed that that bill may not exit that Senate floor before you have a summer recess, and maybe speculation is you won't get a vote on this before midterm elections in November. We'll see what happens here, but this bill aims to prevent the tech giants, particularly probably Apple, Amazon, and Google, from favoring their own services over competitors and things like search results and e-commerce items that you might buy on Amazon. We'll see where this ends up going. Interestingly enough, one of the co-authors or sponsors of the bill, Senator Amy Klobuchar, who's a Democrat, I believe, from Minnesota, she says they have the 60 votes to pass this out of the Senate. Just shows you the dysfunction in Washington. Anytime you have a bill with bipartisan support, well, all of a sudden, when it gets close to the finish line, a lot of things can happen and likely delay that vote into the future. We'll keep close tabs on that. TikTok and YouTube are seen rising in their usage rate during Q2, but Instagram and Facebook see declines. And this is kind of natural as we're seeing the shift in the web. Those of you that may not remember, like the early days of the internet, it was all text-based. And then we moved to a little bit more pictures and things like that. As bandwidth and internet speeds got a little bit faster, you could load pictures and banners onto the page. Well, we've slowly started moving more towards video and streaming audio and those types of formats, and that's certainly going to benefit like a TikTok and a YouTube, which whole platform kind of revolves around that, whereas Instagram and Facebook are seen playing catch up. But I don't necessarily think it's a game that they'll lose. They'll eventually catch up. But what we did see in this is the fact that TikTok, while it's continuing to grow, understandably and probably predictably as well, that platform is starting to slow a little bit in its growth rate. So showing that maybe it, like a lot of platforms, and look, TikTok's gotten way huger than I think almost everybody probably thought it was going to get, but eventually you hit kind of the law of big numbers, or you just cannot continue to grow. That actually, I think, is good news for Meta in the long run. Now, Meta shares were up earlier this week as Facebook to allow individuals to have multiple user profiles. So this is how Meta is going to respond to the fact that TikTok and YouTube are seeing gains in their usage rates and Facebook and Instagram are starting to pull back. This headline is somewhat misleading. Basically, what it's going to allow you to do, if you already have an Instagram account or a Facebook account and you want to kind of like maybe have a segment of your Facebook account, you want to have a profile for your work audience. So you have all your work buddies in there. Maybe you've got your college buddies that you want to be able to communicate differently than maybe your work buddies. Maybe you're a parent and you have other parents, or maybe your mom or your dad or their grandparents. Maybe you want to be able to share pictures of your children and not have that go to every single one of your friends over on maybe Instagram or Facebook. Facebook's going to allow you to do this. I don't think this is going to change how they count daily active users. I just thought that headline was interesting after we saw evidence that their usage rate is going down compared to competitors. Moving on to Apple, which just keeps trickling up to the top of a range that we've identified in the technical segment of the show, which will come on the back half of the program. Started the week at $144. Apple closed the week much closer to $150 per share, after Apple is most likely the winner of the NFL Sunday ticket rights, which could cost over $3 billion, not $3 billion total. We're talking about $3 billion per year. You're probably looking, I would guess, at least a 5 to 10 year agreement on something like this. So you're looking at a $15 to $30 billion kind of commitment to show the out-of-market gains games on NFL Sunday Ticket. Again, this does not start with the upcoming NFL season. It's the season after the one that is about to be played. Now, this is according to Puck News, which quite frankly, I have never heard of, might be very reputable. And quite frankly, this would make a lot of sense because Roger Goodell, which is the commissioner of the NFL and who helps kind of facilitate these types of deals, he says, I clearly believe we're moving to a streaming service, essentially meaning he's probably going to move to either Apple or Amazon. And when we're talking about $3 billion per year, the one company out of the two when it comes to Apple and Amazon, and quite frankly, the one company out of all of these, minus probably Microsoft, the one company where $3 billion, you wouldn't even notice if it disappeared from the company's balance sheet, from its revenues. You wouldn't even notice it if it came to Apple. That's why it makes so much sense that they go with Apple on this, and it is a big, big growth driver in the future, and I'll show you a story here in a moment. But I did want to talk about how you have Champions League as well. Those are soccer rights. Those are expected to top $2 billion. That's for a 6-year deal, so it just shows you how valuable the NFL rights are. Those are worth over $3 billion a year for a 6-year deal to Champions League, which I have heard of. It's not something I'm familiar watching. I just know that this is a huge league in soccer. You're looking at a 6-year deal worth $2 billion. You've got all the usual players from Disney to CBS to Fox to also Apple and potentially Amazon as well. I tell you what, in a couple of years, I would guess over the next 4 to 5 years, Apple is going to roll in all of the most important sports rights into their package. It's going to create a dominant, we're talking about a dominant player in that streaming platform. That parlays us into our next story about Apple, the fact that B of A, an analyst, is saying that Apple's advertising business could be worth $20 billion by 2026. He estimates at the current time, they've got about $5.3 billion worth of revenue coming from Apple Store ads. So this is if you own an app or you just created an app and you want to move to the top of the App Store, one way to do that, the easiest way to do that, quite frankly, is create a great app and then advertise it. They also think other areas like Apple Maps could generate quite a bit, but they also recognize that Apple TV Plus could bring in an additional $10 to $12 billion worth of revenue by 2026. And you'd expect if this company brings on a $3 billion a year NFL license, they already, as we talked about, has a deal with the MLS. They have Friday night, I think, or 1 week a week, they show MLB baseball games. Eventually, this company is going to have some of the best, we're talking about the best sports rights that you can own. And they're going to be able to create a lot of content and sitcoms and movies that they're going to be able to advertise against. This is going to be a wonderful business for Apple going forward. Apple's cutting its trade-in prices, and this could be a sign that there's strong demand. So I saw last week that they cut their trade. So if you're trying to trade in a phone, they give you a certain value. They cut those as we head into kind of a new product cycle. They don't necessarily want to give you as much money for maybe older devices as they would when those devices were a little bit newer and we were further away from a new product. I saw evidence that this is just something like clockwork with Apple, but some of the analysts are noting that, look, if iPhone demand or product demand was weak over at Apple, they might maintain higher than average trade-in prices to keep moving through inventory. This is showing you that potentially maybe Apple has pretty strong demand now. Now, Apple rose this week, as we saw in general, but even as a report that it had severed ties with its consulting agreement with long designer Johnny Ive. This was a couple of years ago. Johnny Ive actually left the company, but he started his own design firm, and there's belief that he even helped design the upcoming, long rumored kind of AR VR device that Apple is expected to come. Now, he has clients such as Airbnb and others that he'd like to exclusively work with without the permission of Apple. I think he also has grown tired of Apple's culture, considering he was used to maybe a slightly different culture over at Apple. I don't necessarily think this negatively impacts Apple at this point. While his contributions to society in general, massive, he's free now to go do whatever he pleases. Moving on to Amazon, started the week at $112. It was Prime Week, and Amazon ended the week a little bit higher at $113. This is after analysts applaud those record Prime Day sales. Amazon said that they sold, I believe, over 300 million items and over $3 billion in sales over the course of 2 days as Prime Day, but they really stretch it out to be about a week. We noted here on the program that we thought an event like this would maybe get a little bit more buzz does in the inflationary environment that we're at. Anytime you have prices dropping or the perception of prices dropping, it could attract a lot of traffic. Now, this headline is a little bit misleading because Amazon did follow up on that. I'll talk about that here in a second, but Amazon trims its private label selection due to weak sales, considering exiting the business under regulatory pressure. So if you're not familiar, on Amazon.com, they have created over 243,000 products. I would guess it's well in excess of that, quite frankly. Over 45 different house brands. It's more than that, I guarantee you. And these all these products essentially compete with other third-party sellers and other brands on the platform. Like if you're searching for like Levi's jeans or just a white t-shirt, they're competing against Hanes, which is selling on there, and also third-party sellers that source these items and sell it on there. Amazon obviously able to do that and likely being able to not have as much overhead or cost that the other sellers might have on the platform. Many believe this to be anti-competitive, maybe even antitrust, something that Amazon should be shut down for, at least shut down these house brands. It was rumored that maybe they did that, but Amazon came out with a statement, and this makes a little bit of sense, that they say, we, Amazon, never seriously considered closing our private label business, and we continue to invest in this area just as many other retailer competitors have done for decades and continue to do so today. That, I believe, is probably the case. Amazon's not going to invest this much in private label and to just completely shut it down. The government is going to have to come in there and shut it down, in my opinion. Now, Amazon's documents reveal how worker performance is monitored. This was an interesting story that came across, and it noted that there was a Staten Island warehouse worker that notified that he tallied 19 products in a storage bin, which actually held 20. And there's also evidence the fact that Amazon warns employees if they exceed break time by about 4 minutes and meet 94% of the company's productivity goal instead of the full 100%. So if you're 6% off over at Amazon, or just one off in a basket of 20, which is about 5%, I guess, they will let you know about it. I tell you what, folks, this is how society works. If I made one mistake on this video, someone's going to let me know down in the comments below, and I actually appreciate that. Now, whether or not Amazon does this in the most tactful way, maybe there's other ways they can communicate this to workers that says, hey, you're doing 94%, but let's finish up that last 6%, or you got 5% of the products right. Let's get it right all of the time. I think Amazon probably can communicate this better. I would guess that's something that they should work on in the coming months ahead. Moving on to Netflix, as we are on the eve of Netflix earnings, I did a preview video of their earnings. I'll put a link to it down in the description below if you did not see that video. Netflix started the week at $181 per share, a big time. Is this right? Of $14, over 8% today to $189 per share. Again, on the eve of earnings, Netflix is setting well up towards the top of the range technically, and that could be interesting, especially when we're talking about the rest of these stocks heading into next week. Now, again, we have earnings week next week. We've got Tesla, we've got Twitter, we've got Netflix, Snapchat, and more. We'll probably do videos on all of those stocks. Now, Netflix rose this week after it announced a partnership with Microsoft to be its global ad sales and tech partner. So obviously, it's been long rumored that Netflix has been looking for a partner. My guess is they interviewed all the relevant parties, and I think they picked a really good partner here with Microsoft in a lot of different ways. Okay, first of all, they don't have a direct competing product. So if you would have partnered with a Google, they have YouTube, they have YouTube TV, which made some news this week. We'll talk about that. They could have partnered with the Trade Desk, but I think they just signed a deal with Disney, and they do a lot of work with Google as well. Microsoft was kind of the perfect play here. The other thing that I think, okay, look, in a clean regulatory environment, we also know that Microsoft has a $69 billion deal with Activision Blizzard. Again, a new story on that coming soon. But in a clean regulatory environment and an access to capital, I tell you what, Microsoft would be an absolute great partner for Netflix in terms of a buyout, because this is the one property that Microsoft does not have, is kind of a streaming video. Imagine if Microsoft bought Netflix and all of a sudden they're competing with Apple for those sports rights. I bet the NFL and the NBA wish that would happen. Now, Netflix is said to be talking with its Hollywood studios about support for its ad-based subscription. So essentially what's going to happen is Netflix is going to have an ad-supported tier to watch its services, whether or not you have to pay $1.99 or $3.99 or $4.99, and then you have to watch ads on top of it, or if it's completely free and all you do is watch ads during the breaks, I am not exactly sure which direction Netflix is going to go. They might not even know, but they are going to have to talk to the content providers that they essentially lease programs from. So the Seinfelds, the Offices, all the different sitcoms that Netflix tends to show, they're going to have to make sure it's okay. They can offer that on the ad-supported version of Netflix. That could complicate the rollout a little bit or make the rollout not necessarily as good as it could potentially be because maybe not all the content is there that people want to watch. Moving on to NVIDIA, start of the week closer to 152, end of the week higher, closer to 157. This is after semiconductor stocks and a little bit of mixed results after Taiwan Semiconductor Manufacturing, which is TSM, had strong Q2 results. We also posted a video on that earlier this week. They also gave strong guidance as well. I tell you what, when we went through TSM's earnings report, it was like, oh my God, this is like a FAANG stock. You could include this on this show. The thing is though, all of these companies that we talk about here on the FAANG Stock Recap Show are essentially like a proxy or an affiliate for TSM. They all get their products, they all run their chips and their services, essentially touch a TSM product at some point. But what a fantastic business they have going there when it comes to the financials. NVIDIA piggybacked a little bit off that as the stock ended higher this week. NVIDIA fell though earlier this week. A lot of these stocks kind of went up, went down, came back up as Citi lowered its gaming related estimates and added that the data center strength is still intact. Obviously, gaming related over at NVIDIA is also cryptocurrency mining as well. And obviously, as you see the continued fall in cryptocurrencies, it becomes less profitable to mine those cryptocurrencies. And obviously, the price you pay for the ASIC miners has to fall, the demand, everything falls, and that will certainly hurt NVIDIA. I tell you what, you get a rebound in crypto, or quite frankly, a stabilization at the current levels, that could be bullish for NVIDIA moving into the future. Moving on to Google, start of the week at $2,317 per share, ended the week closer to $2,235 per share. This is after the DOJ is likely to reject Google's offer for an ad tech split. This is according to a report. We talked about that this last week. The DOJ is ready to put the smackdown on Google. The fact that they have ad tech rolled up into an ad auction system, and then finally the ad display system. Everything you do at Google, this is one of the reasons why it's such a powerful company. It's such a large company and a key company in the stock market. If you want to buy online advertising, you literally have to buy it through Google. You have to use their auction system. You have to show it on their platform with their ad servers, with their ad tech. Yes, you can use the trade desk. There's other ways to get your ads on Google, but for the most part, someone is dealing directly with Google. There's not a lot of transparency there. It appears that Google wanted to split the ad tech business off. Now, it was just going to split it up amongst the parent company. And I don't blame the DOJ for kind of having maybe a belly laugh when Google kind of brought that forth. It's not like they're going to spin this off into its own separate public company like eBay did with PayPal. No, they're going to keep this under the parent brand and just say, oh yeah, it's separate. We don't go knock on the door, on Google's campuses from the ad tech. No, it's not going to work that way. Antitrust lawsuit likely coming forth. It's probably going to play out a little bit. A lot of these things are more political and money based, and we'll see how they work out. We'll certainly be here to follow that story. Now, Google plans to ease their hiring in the second half of 2022. We see this across almost all of these companies. Now, Alphabet dipped even as Google says its YouTube TV subscriber count has topped over 5 million. That would put it in excess of Hulu Plus Live TV, which says it has 4.1 million paying subscribers. So YouTube, though, puts their figures likely with free subscribers as well. So it's not exactly sure if they have 5 million paying subscribers or how many of those 5 million paying subscribers are actually paying or if they're on a free trial. Either way, they're just showing you great adoption into YouTube TV, obviously giving them a lot of ad business as well. Now, Google countersues Match.com, accusing it of bad faith dealing and breach of contract. This is what happens when these things go to court. Google, again, according to them, they're saying that they want monetary damages from Match after the company is simply refusing to pay for Play Store app store fees on top of the subscriptions that they sell on Match.com and Tinder and the other dating site that Match operates. They obviously want to stop paying that fee that they do to Google. That would be a massive amount of money flowing onto the bottom line. Again, we'll see how these app store kind of tax stories play out likely over the next, I would guess, 2 years probably. Moving on to Microsoft, start of the week at $262. This one broke down actually a little bit, but not in a big way, down to about $256 per share. This is again on the heels of announcing that ad partnership with Netflix, again in a clean regulatory environment where these companies could pretty much buy and do whatever they want, maybe have access to capital. I think Microsoft would be looking to buy Netflix. This would be a great addition to that company. Whether or not that happens or whether or not Netflix even wants that to happen remains to be seen. Now, Microsoft is said to have responded, well, of course they did, to the FTC's second request in that Activision deal. Obviously, this is something that's going to continue to be litigated, or investigated is probably a little bit better word. You've got a $69 billion deal. I bet Microsoft wishes they waited another 6 months because they probably paying about $39 billion. This is a great deal for Activision Blizzard, which saw this deal close before a lot of equity and asset prices started to decline. Microsoft still will work out pretty well if this deal is able to go through from a regulatory perspective. Now, Microsoft reportedly cut about 1% of its company workforce, again, trimming around the edges. We're seeing that at Google. We're seeing that at Tesla as well. Now, speaking of Tesla, started the week at $742. Like Microsoft, actually ended the week down closer to $720 per share. This is after the Twitter hearing for an expedient trial sets for Tuesday. So we'll likely hear if we'll get kind of a fast trial on this, or if this is something that might drag out in the courts. Now, I had a lot of comments on my video. This story broke, or not this specific story, but the fact that Elon Musk decided to terminate his deal to acquire Twitter. That broke last week. A lot of people wanted some information on that. Look, this is extremely entertaining. The news flow on this has been awesome. I have loved to cover this. I would have loved to do a video on this, but literally the news changes about it every other day. So whatever I had to say on it on Monday would likely be out of date by the time a lot of people watched it on Tuesday or Wednesday. But in the long run, we see this deal. It's essentially terminated and Tesla stock went down. I don't think the two are interconnected as much as maybe kind of the retail investor is trying to assume here. Tesla can be very, very successful, and Elon Musk could buy Twitter for any amount of money. It really would not matter. Obviously, some financing of those shares, him leveraging Tesla's success to buy Twitter, some of that is intertwined, but I think a lot less than retail investors believe. Essentially, when we get earnings next week with Tesla, we're going to see likely a very healthy company, regardless of what Elon Musk decides to spend his money on. Now, he is still tweeting, referring to Elon Musk, saying that Tesla could lower car prices if inflation shows. I think this is kind of a no-duh thing. He says if inflation calms down, we can lower prices for cars. Whether or not they do that, it really would probably depend on competition. If competition is getting prices for their cars, or if Tesla is selling cars for 60, 70, 80,000 and they can continue to pass those prices on, I think they will. In my opinion, the inflation we're seeing now is not going to turn into deflation, where all of a sudden you're going to see prices decline across the board. Yes, you're going to see certain goods, gasoline, energy prices, maybe to a certain degree, some things come down in prices, but are they going to go down below where they were in 2019 and 2018? That would be deflation, in my opinion. I don't think we're going to see that. I think we're just going to reset to a lower level where all of a sudden gas is going to be $4 or $4.25, and people are going to say, wow, that's really low, when, oh, okay, yeah, in comparison to $6, it's really low. But I remember not that long ago filling up my Mercedes for like $2 a gallon. I don't think we're going back to that. That's why I think Tesla's prices probably remain high on their cars. Now, Tesla added 32 supercharger stations in China during the month of June. That's like one per day, and they expect to add more in 26 cities in July. This is also kind of a no-duh type of thing, but this goes overlooked, especially kind of the bear case argument in Tesla. These superchargers are the backbone of the company. Unless you're charging your car at home, imagine buying a Rivian, imagine buying a Lucid, imagine buying any kind of Ford EV, and living in an apartment where you don't have access to plug it in right away. Or out here in California, if you don't have solar on your roof, I can only imagine what your electricity bill is. You're going to rely on charging that car somewhere else. And quite frankly, the only network out there that is robust enough to support most people is the Tesla supercharger network. The more that grows, the more competitive advantage Tesla has. Now, Tesla's AI head departs after a lengthy sabbatical. So this gentleman, Andrej Karpathy, he announced that he left the company on Wednesday. He was the head of AI over the last 5 years or so. Now, he has been off of the job for about a 4-month break for unspecified reasons. And now he's leaving the company, and he's not really leaving to any new opportunity. I think my only thoughts are with Andre at this time. I hope this guy's doing well. It sounds like maybe he's having some tough times in his life. He had to take a sabbatical. The company didn't want to disclose the reasons why, likely for privacy reasons. He's leaving the company after taking those 4 months off. He's not going to a new position. Certainly, if you're the head of AI over at Tesla, you probably have people knocking on your door for opportunity. Certainly, other car companies, other AI startups would love to have somebody like that, but they'll put out a press release that they hired him. Well, he's not going on to that. So I'm just praying for him and his family. Hopefully everything's okay. I think Tesla will be just fine, even though the head of the AI division is leaving. Now, obviously, analysts believe that as well. Truist believes that AI innovation can turbocharge growth. They talk a lot about the self-driving, but I think we'll get an update sometime this year as well on that robot. I actually think that robot is a very, very interesting product that Tesla has down the pipeline. Not necessarily something that's going to generate a lot of revenue over the next 18 to 24 months, but I'm starting to look 36, 48 months down the road. All of a sudden you have a robot producing, a lot of efficiencies at companies. Well, it could be a very in-demand product. Now, Panasonic picked Kansas for a new $4 billion electric vehicle battery factory. We also have more news on Panasonic as they're pushing for 20% increase in battery density. This is over the course of this decade. Now, Tesla files a warning of notice on expected layoffs in San Mateo. According to documents, they're laying off about 229 people. They are closing the San Mateo office. These are mostly hourly workers tasked with labeling training data. My guess is you probably can train somebody at a much lower cost to do those types of things than an office worker in San Mateo, which would have to make $70,000, $80,000, $90,000 not to feel completely broke. Moving on to the technical segment of the show, we'll kick things off with the S&P 500. A little bit, as we head into earnings, a little bit of uncertainty. Okay, you got kind of higher lows here, but and again, we're talking about in the shorter term, like over the last couple weeks or so, but you're making lower highs with here. So the market's kind of, trying to figure out what's going to happen, probably just waiting for these earnings to come across. We saw some bank earnings this week. Some of them were good. Some of them are bad. They're kind of uncertain. There's a lot of uncertainty. Not a lot of people are really sure. Are we in a recession now? Is it going to come in Q3? Is it going to come in Q4? If it doesn't come in there, that means it's probably going to come next year. So how are you positioning yourself? It's actually kind of difficult. And then, we're seeing a little bit of wedge out in price. We'll get some certainty in the markets likely here in the coming days ahead. Now, moving on to Meta from a technical perspective, not really doing anything different than the S&P 500, making some higher lows along here. Okay, pulled back a little bit. We've got some overhead resistance up here at about $171 per share. This company reports their earnings on July 27th. So we're still 12 days away from earnings over at Meta. Depending on how things go next week with Tesla and Netflix, wouldn't surprise me if this one sets up towards the top of this range. I think you could get up to about $170 per share, and then you're looking on earnings. Can you break back to the top of the zone? Look, this stock could rally after earnings all the way up here to like we could add $30 to the share price of Meta, and it's still technically in a downtrend. So I think these stocks are going to make some big moves. When they make those big moves, just pull up a stock chart and see, okay, yeah, it's up 30. Oh, that's awesome. Well, technically it's going to head its head up here. And if this technical pattern stays in place, and look, when it comes to technical patterns, either you can argue with them, you can not believe them, or you can say, look, this technical pattern is going to be in place until it does something different. With Meta, it could come up here to 195 and you'd expect it to crash, come back down down, at least back down here to the 160s, 170s. The thing that it would do different with earnings, and goes for all stocks, not just FAANG stocks, but all the stocks that you're looking at, you're looking for it to finally do something different from a technical perspective. With Meta, you're looking for a burst up into the 200s. You burst up into the 200s with this one, and oh my gosh, that is something completely different. The other thing that could be slightly different with Meta is a bust down to the bottom, but that would have to be a considerable move on this one. You'd have to get south of probably about 130 for you really to say, hey, you pooped out the bottom with Meta. Now, moving on to Apple, doing what we thought potentially was possible with these stocks as we head into earnings with Apple, which happens about 13 days from now, nearly 2 weeks, just short of 2 weeks from now. On July 28th, we should get earnings from Apple. We talked about for the last 3 or 4 shows that it wouldn't surprise us if the momentum, the shorter term momentum is actually to the upside in the markets in most of these stocks. Wouldn't surprise us if Apple started to set up towards the top of the range. Now, will it get all the way to this red line, which would take it in the shorter term up over 155? Will we get all the way to the top of the range? We're pretty close. I mean, we're literally just a couple of dollars short of getting up in there, and then we'll have to wait on earnings. If you get positive earnings over at Apple and you burst out of this, that could be incredibly bullish for the markets, not necessarily in the shorter term, but also could signal that stocks have maybe started to find a little bit of a bottom. The other negative thing that could happen is you could poop out the bottom and you break down below this channel, which gets you south of 129. You get south of 129, get your checkbook and your cash ready. That is a buying opportunity in my opinion. Now, moving on to Amazon, just setting up a lot like a lot of these stocks. Okay, very, very shorter term. We're talking about just over the last couple of weeks. Yes, you are making some higher lows on that chart, but then stretch it out to more of an intermediate term and you're making lower highs. The market just simply cannot decide if the markets want to go up or down. In these cases, yes, there are some fantastic ways to make money, but me personally, I just wait until the market decides which way it wants to go. I am not trying to be Albert Einstein over here. I'm not trying to be Miss Cleo. I'm just trying to make the best decisions I can with the most information we have. Right now, we have very little information on which way these markets decide to go. With Amazon after earnings, which we're expecting about 13 days from now, same day as Apple on July 28th, you're looking for a break above probably 130 on this one. You break above 130. Hello, that is telling you from a technical perspective, at least in the very shorter term, some interesting things are happening. Now, the opposite could happen. We could poop out the bottom of the range. I keep using the term poop. You can tell I probably have 3 and 5-year-old boys. That's all they tend to talk about sometimes. Well, we could dump out the bottom of the range anywhere south of $100 on Amazon, I think is a fantastic buying opportunity. Now, some of the reasons why we're basically assuming that we're going to start setting up towards the top of the range on the Apples, on the Amazons, on the Metas, all these stocks is look what happened to Netflix. Again, Netflix reports their earnings just 4 days from now on July 19th. And look what the market decided to do the last full trading day before the week before earnings. They put up a gigantic green candle on this one and set it up. Yeah, you guessed it, right at the top of the range. In fact, over the range. I'm shocked that the market decided to do this with Netflix. Maybe they have some great inside information. Maybe there's just the sellers decided to dry up on this stock. As you can see, it's just, I mean, this used to be a $700 stock in the last 52 weeks. Now it's obviously closer to 190. So it's natural that maybe in that scenario, sellers have dried up. We're sitting at the top of the range with Netflix. Next week, you're looking for a break even higher than that because you're still technically in this downtrend and you stretch this out to a much longer term. I mean, we're talking about a crazy downtrend on this stock. When we're talking about how we're broken out of a trend on these stocks, we're talking about in the very, very, very micro term. We're talking about over the last 30 days, really since last earnings report, we have somewhat broken out of this wedge formation. It'll be interesting to see. Netflix has got a couple of days before it reports next week. We'll see how that sets up. Moving on to NVIDIA, walked back to an area where it makes a lot of sense with NVIDIA. There's some demand for this stock up here in kind of the low 150s to 160s on this stock. Wouldn't surprise me if it consolidates a little bit. Earnings are a little bit further out on NVIDIA. You don't get those for over a month on August 24th, but by then you'll have had Intel, you have AMD, we obviously had TSM earlier this week. You'll have almost all the information you need to know with NVIDIA, so there could be some opportunities there. Moving on to Google, we identified last week. This one is looking really beautiful. Over the last couple of weeks, it has created a series of higher lows. Pulled back a little bit this week, but nothing alarming. You wouldn't want to see this one drop below that, get down to about maybe 2110, 2100 is probably where you could call this one. You wouldn't want to see a big red candle below that trend line. Essentially, that would cancel out everything that you had going on over the last couple of weeks, creating these higher lows. After earnings with Google, which we will get on July 26th, so we're still about 11 days away from Google, you want to see a break back up here to the top of the channel, actually above these lows, north of about $2,400 per share. Understand though, even if we put it, let's assume we put up this big green candle heading into earnings. They announce earnings over at Google. They're not as bad. Guidance is good. You put up a green candle, you get up here to maybe, we'll call it even 2,400, close to 2,500. Understand though, still in the little bit longer term, you have this kind of thing going on where you have some highs up here at 3,000. You made another lower grouping of highs here at 2,800. You could come up here even north of 2,500. You're still essentially setting up kind of this downward trend line we'd expect. So even if these stocks react positively to earnings or guidance or whatever it might be, even if you might feel that, oh no, I missed it. You know, all of a sudden Google's a $2,500 stock in 2 weeks. Don't worry. I wouldn't be overly concerned because the chances are if you make that type of move, you're going to get rejected on the longer term trend. And probably better way to say that is the intermediate trend. The intermediate trend with Google is down. Okay, the longer term trend, and we're talking to the beginning of this company, is up, and it's up big. So that's why we're always looking to get into these stocks, get back into these stocks. When they go down, we're looking to buy them because the longer term trend is up. The intermediate term is basically down and sideways. The shorter term, the micro trend, is actually up. So if the micro trend turns positive, you'd have to really cancel out the intermediate term to really say, hey, I missed it. I should have bought this stock. No, more than likely, if the shorter term trend really gets overbought, well, the intermediate trend will take over and reject you lower, but that can trigger those really nice buying opportunities with a lot of confidence. Moving on to Microsoft. This one was up towards the top of our channel last week, got rejected, put up a big red candle this week over at Microsoft, rebounded a little bit, found some support here. Microsoft just kind of hanging out towards the middle and the top of the channel here. You're looking for some clarity with Microsoft. Microsoft channel is as beautiful as it gets, quite frankly, okay? You're looking for a break above this channel. A break above the channel doesn't really say anything in the shorter term. You'd really have to bust out of this one. I mean, you're getting back to $280, $290, $300 on this to really take it out of this downward channel. A really negative move would take you down to the bottom of the channel, down south of probably $240 per share. Those would create buying opportunities. Finally, Tesla, which reports their earnings just 5 days from now on July 20th, a day after Netflix. Again, setting up just like Google in the very shorter term, creating an uptrend where you're seeing a little bit higher lows. Now, that uptrend is not really confirmed because you haven't really created a lot of higher highs along the way. They've kind of stalled out here right at about $750, $760, almost $770 per share over at Tesla. After earnings at Tesla, which are pretty well telegraphed, we know how many cars this company delivered. We know about the average price they'll likely sold them at. We know the average gross margins. We know these types of things. You might not get that big of a move on Tesla, but a big move would take this one north of about $770 per share. You get north of that, then it brings back in the top of the channel. But again, even if Tesla were to rally big, I mean, we're talking over $250 per share to take us over $970 per share. Shoot, this one could get all the way up here to $1,100 per share, and you're still technically in a downtrend in the intermediate term. Again, longer term, all of these stocks are pretty much locked in uptrends outside of probably Netflix. Intermediate term with Tesla, we're basically sideways on this one. Micro, shorter term trend, we're definitely heading upwards. Even if you have big momentum in this one, taking you up here to $1,000 per share, and you're sitting there with a ton of FOMO saying, I should have bought it down here at 7. Don't worry. The chances are you'll get rejected here, pull back to this trend line, which would almost likely still be intact. Pull back to that trend line, in my opinion, is a lot more confidence than just guessing here, because the other thing that could happen with Tesla is they could live a gigantic brick. Okay, this company is firing people, and while they have a backlog of business, that business could dry up at any time. You could see slowing of demand of $70, $80, $100,000 cars, especially in a recession. You could break down to the bottom of this channel and you could get down here easily south of $600 per share on Tesla. In the shorter term, you've got a firm level of support on Tesla. You would not want to see 600 broken on Tesla. You break below that to any significant degree. Quite frankly, you'd have to get down to probably south of 550. You break south of 550 and more than likely you're coming down to probably $300 to $400 per share on Tesla. Again, they report on the 20th. We'll be here to cover it for you on the channel. Until then, I hope you have a wonderful week and weekend. We'll see you again next week with a lot of videos. Thanks for tuning in today and good luck with your investments.